G'day, good evening, everybody. Steve Goodey here. Great to have you on board. I haven't done one of these for ages, and I feel like I'm rusty as hell, so please bear with me. But I'm coming to you live and in the dulcet tones from Wellington Central, where I live. Great to have everybody on board, and wow, what a result from this webinar. Realistically, for a number of people signed up and ready to go, really impressive, actually. We didn't expect to be overridden by people this much, but I think that there's a groundswell coming, and I'll explain that a little bit more in a little bit more detail. But hey, thanks everybody for saying hey in the comments there. I can see everybody making comments and saying where they're coming from and this bits and pieces, so that's really great to see. Thanks so much for joining us. So tonight, my guest speaker on the webinar is Mr. Dave Windler. Some of you will have worked with him before or know who or what he is, but he's recently been given the accolade of the Astute Financial Advisor of the Year 2023. He's been a mortgage broker and advisor for 15 years. He's one of the best in the country, in my opinion, but also his method of delivery and his way of explaining things is just so uniquely good. He runs a very big team, and they run nationwide, and that's why they've been able to write over $1 billion worth of mortgages. And he does a lot of mortgage work for a lot of my clients and myself personally, and he's stuck around late in the office tonight, and I don't think that's a rarity. I think that happens quite a bit at the moment from conversations with him. He's pretty flat out, so we're really lucky to have nailed him down for an hour. And so, without further ado, I'll throw Mr. Windler in there. How you doing, fella? You well?
Yeah, mate, great intro. Yeah, no, just I actually slipped home for a bite to eat, slipped back to the office, and there's still a couple of people here, so probably a bit of a sign that we're pedaling pretty fast at the moment.
Yeah. Well, I was just giving you grief about Jack, your son, and he's in the office there with you still as well. So everybody's burning the midnight oil. And tell me, why is that? Why are you so busy?
Well, there's a bit of change in the wind, right?
Yeah, there is.
Yeah, look, I was at a presentation the other day with which was done by Nick Goodey, who's the CoreLogic economist, and his opening slide was, demand is out there, but it's held back by the availability and the cost of credit.
Yep.
And I just about stood up and gave him a round of applause, on his opening slide, because
you dropped the microphone speech over,
he could have stopped there and he had me.
Yeah.
Because I think that we haven't stopped being busy.
Yeah.
And if I think around, a lot of our work though has been almost sort of non-income producing for us. Most of the time we get paid with cons, but we've had a lot of demand, a lot of inquiry, a lot of restructure work, a lot of interest only applications, and at the back end of that, demand has quite often been, look, you can't quite do what you want to do, but it still takes us hours to go through that process of servicing that inquiry. All right, now we've got a whole heap of stuff now starting to happen, which might mean that we're starting to give out different answers.
Yeah, and that's largely what I was hoping to have conversations with you about tonight. But, to start that up and to initiate it at this point, the first thing I would say for any newbies online tonight, what sort of hoops do they have to jump through to actually get finance at the moment? What's the dream customer coming on your lap look like? Because it's got to a point where the paperwork war is just about insurmountable for proving who and what you are. What is it that you actually require to get somebody to a position where you can take them to a bank, get some funding for them?
Oh, look, I think it all starts off with a clear understanding of what it is that they're trying to achieve.
Yeah.
It starts off with a conversation. And once we start to understand that, then we can start to formulate some ideas as to how we're going to help support make that happen. The application process these days, we use a portal. So you data enter in your stuff and your supporting documents, and it's all pretty formulaic. It hasn't really changed for a long time. What's changed a lot is the interaction or the requirement for us to really, really micro understand the information that appears in your bank statements through what we've all talked about with the triple CFA. Now, the great thing is half of that stuff's gone now and been repealed. So we start to go back to Nick's statement around availability of credit. Well, the triple CFA standpoint has now very definitely changed, and in the last sort of week and a half, we're starting to get communication from the banks as to how it's changed. Little examples, you've got a credit card, triple CFA, raised the bar, so you have to put 3.8% of your credit card limit in to the servicing calculator, whether you use it or not. Now that's being pulled back to 3%. Small change, but it all adds up. Okay. Verification of the vast majority of expenses. It wasn't good enough to suggest that your house insurance was X amount of dollars a month. We had to prove it. If it wasn't in the 3-month statements, we had to go and get an invoice from the insurance company. We don't have to do that anymore. What the customer says they spend, what the customer says they spend is now taken as read.
Yeah.
So the arduous nature of the application, I think, has softened a little bit, and will give us a little bit more playroom with how we handle and interpret numbers, so that we can get a higher success rate with what we're looking to try and achieve. For sure.
And then there's bigger things too, like next week the banks are all going to be looking to see if the official cash rate changes, and it's on a knife edge. I don't think he will move yet. I know. I wish and hope and believe that he should, but normally the Reserve Bank doesn't move until it's too late, and it's already too late to save the industry, the market, whatever you want to call it. But I don't think he'll move yet. I think it'll be another no move. Myself personally, that's my prediction.
At least there'll be at least another one for the road, right?
Yeah, but all of the Main Street banks believe that the OCR is coming down or will come down between now and Christmas, to a point where even BNZ's projection has shown that it's going to drop a lot faster now than it was previously. And that's why, excuse me, and that's why you see all of these near-on predatory interest rates coming out of the banks at 5.99 for 3 years, because they want investors to fix for 3 years, because they feel and know that the interest rate's going to be well below that once they get to that 1 and 2 year rate. And that's why I never give anybody any advice on what they should do with fixing their mortgage. And you've seen this through the years, you and I. I get asked a lot, what should I do with my mortgage, Steve? And I'm like, well, it's different, because I'm not you. I don't have your risks and your cash flow and your stress and your assets.
Why not?
And so I push them onto you, make it your problem, and go and talk to your mortgage advisor, go and talk to your broker. They've always got great ideas. But
it's never always about the price, right? And it's always about the circumstances that surround.
Absolutely, yeah. And everybody's circumstance is totally different. So what I'm saying from there is that the only indication I would ever give is what I'm actually doing for my portfolio right now at the moment. And at the moment, I've got an awful lot of stuff floating, and some of it's floating at 8%, and I could fix it at 6.3, 5.99 probably, but I'm not going to till I'm going to look at it middle of next week, because I want to see what the OCR announcement is and how strong he is on, because it's a whole different thing if he says, no, we're not going to drop it, or if he says, no, we're not going to drop it now, or if they throw us a little 0.25 or something and start the ball moving. And then the banks are just going to drop interest rates even further, and there's going to be a mortgage competition. And additionally, tell me if you're seeing this as well, and this might cover some questions we have later on as well, but banks are getting P&I mortgages paid back all the time. Banks are actually really flushed with money at the moment. They want to lend this stuff out, and banks make no money if that money's just sitting in their coffers.
The appetite's increasing. I mean, I think just touching on the rate piece, Dave, I sort of like to make sure coming on, take a look at, what's going on in market. And, the vast majority of the work that we're doing now is refixing at 6 months, or if people are taking on new lending, we're doing the 6 month mark. And the market rate on that's sort of pretty much 6.89. Okay, that's market. Once you start looking at the 1 year rate, market's now sitting, just dropped quite a bit on the 1 year money. And market now sort of sitting at 6.65. And then after that, I wouldn't have a clue.
Yeah.
No, I do know, but I haven't done anything beyond 1 year for quite a few months now. Go back a month ago, 2 months ago, might have done a little bit at 18 months with quite a lot at 1 year. But after the last sort of monetary statement, and certainly signs that we're going to get rate drops sooner, the vast majority of the work we're doing now is on the 6 month money.
Yeah. And then additionally, you look at these clients and you're going, how much lending have you got? And when's that coming out of fixed? Because you don't want everything coming out all at once. You want to, randomize it somewhat so that you're, getting a sample of the marketplace. But then what winds me up on forums and Facebook and my own page and bits and pieces is people telling me that interest rates are high at the moment. And I'm sorry, but I disagree. 7.25 is the 25-year average. Interest rates at the moment are normal. We're just been fed really low interest rates for the last few years, and we miss having 4s and 5s. And I'm sorry, but at some point you've got to do the run to safety and go, at some point you've got to stick your peg in the ground and go, I'm going to take a 2 or a 3 year rate and just fix this and push it out long, really. But I don't think we're there yet. I think there's a lot more drops to come. And I think every economist is projecting that, you know?
Yeah. I one of the guys in our WhatsApp group, we have a big WhatsApp group where we chat through stuff, and made note that, you know, the 3, 4, 5s have gone to 5.99.
Yeah.
Nice for a comment around, you know, it wasn't so long ago that people would have walking over, you know, a bit of broken glass for that.
Absolutely.
And I got a lot of stick from a few advisors in the team about how old I was. But it was something, you know, 599 would have, you know, would have been a great rate at certain points in time. So, but it's all relative. Obviously, one thing that goes hand in hand with that is the amount of average debt that somebody has to carry to buy the average house has increased quite dramatically. So, but we've got to look at, you know, another rate that is important to us all, which is the test rate, the servicing rate.
Well, this has got interesting too.
That it has, mate. And you know, so we've had 2 major banks ease their servicing rate by 0.2, 0.25. Now, they've got to have some confidence the rate's coming down if they're going to be doing that stuff, right?
Yeah.
So you start to get all these little green shoots of positive direction. So triple CFA sort of gets diluted. Test rates come down. You've got the sort of the investor changes. You know, bright line test goes, tax deductibility roll. Tax changes come in. Now, the tax changes coming in are only small in some degree, but most bank calculators operate off a net income figure. So all of a sudden, the actual income figure's gone up a little bit. All of these little things add up. You know, the test rate change and tax rate change, you know, on a 500K loan only makes a difference to the surplus of around about $80 a month. Not a big number, but it can be the difference between getting something approved or not approved.
Yeah,
you know,
that's the big thing for me. For me, the big part of test rates changing is if you're with predominantly one bank, we'll call it ANZ, biggest bank in the country, right? And their test rate's at 9%, but over a period of 12 months, they drop that test rate down to 8%, and you've got 10 properties with ANZ, and you've got 1% more servicing across all of those 10 properties, then that's the difference between you being able to buy 2 more properties or not being able to buy anything, isn't it?
Yeah, well, that's the thing when we start talking about test rate. We've got to understand that test rate's not just applied to the loan that you want, it's also applied to every other mortgage that you have over the remaining term of the loan. So if you've got a loan that's been in place somewhere else for 10 years and you originally took out a 30-year mortgage, right? The test rate's applied on a 20-year P&I basis. Now, if you've still got that loan, you've got 3 years interest only to go, all of a sudden it's applied on a 17-year term.
Yeah.
Now, quite often, one of the things we've been doing this year and last to improve serviceability is quite often we've restructured existing debt to improve serviceability.
Yeah.
Yeah, looking at those existing loans and going, okay, well, if we took that out over 30 years, because the client's probably got it interest only anyway because they're an investor client, it makes no difference if we stretch the loan term out, the payment's the same.
Yeah.
And some banks will allow you to lengthen a loan term without breaking the rate. So you could be sitting there on a great rate, afraid to do anything to it in case you lose the rate. But in fact, there's a couple of banks that will allow you to extend the loan term out without losing the rate.
Now, for everybody online tonight who that just went like completely over their head like this, like all of that entire conversation, what Dave said, and I'm just going to cut it down to the core, is call your broker. They can do stuff. And I say this till I'm blue in the face, but everybody thinks that I know mortgages, I know lending, I know brokering. And honestly, if you get a guy like Dave sitting in your corner who's sitting in their office, you know, doing this stuff day in, day out, there's just things that they can do. And what I see here is that this is a marketplace, right? So everybody sitting online here tonight, listening to this information, is getting a bit excited and going, well, maybe I can buy another house. Maybe I can buy another income producing asset. But the entire marketplace is doing that. And the trick to doing that in an emerging market like this, so we've had a bubble, we've had a dip, and it's just starting to come back up again. It's just starting to bubble away. The trick to that is buy stuff early and ride it back up again. And once everybody else in your friend group is talking about this around the barbecue, it's too late. So it's about getting in early and getting this stuff done. Now, I'm going to hit some of these questions we've got on these slides before we answer all of them.
Yeah.
So what's the latest trends in mortgage rates? How are they affecting property investors today? So I think we've looked at that a little bit.
I touched on that, really looking at the 6-month rate at the moment more than anything else, and looking to see what the near future holds, and hoping that our clients will come off those onto better rates, and certainly looking to see when we get to, let's say, a more settled rate environment, where we can start to sort of maybe look at the cash flow on some of those longer rates and lock in some surety. So there's a bit of a balancing act between the two there always.
Yeah, and I mean, everybody's trying to time the market, and I think that it's more about making the most out of the resources that you have, and getting as many assets under your belt as you possibly can, while the market is, still quite low. Realistically, there's some prices out there that are really fantastic, and I don't think that we realize that it will shoot off again at some point. I was trying to explain this to my kids the other day. My son's just bought his first house. My second son is after buying his first property, and he goes, "Are you sure that properties are going to double in value again in the next 8 to 10 years?" And I went, well, no, but history tells us that that's exactly what happens. And if you go back 100 years, why can't you go forward 100 years? And so we're looking at a property that's, say, $600,000, and he goes, well, so if I buy this now in 10 years' time, when I'm 31, it'll be worth $1.2 million. That seems crazy. I said, well, keep going. Figure it out. If you buy it now and in 40 years' time, it's worth $17 million, would you still buy it now? People's head explode. They just can't understand those numbers. I mean, you might be paying $145 for a Big Mac at that stage. Don't get me wrong. Inflation's the thing, but hedging that bet with income producing assets, yeah. Well, I mean, it's been a good idea for me for the last 30 so years. So I got to keep, representing it. So how are the recent government regulations impacting lending criteria for property investors? So we've talked about triple CFA, talked about Brightline. So Brightline's gone from 10 down to 5, or 10 to 5 and 2 if it's a new build. Is that right?
Yep.
2 flat now.
1 flat.
Love that.
So,
2 years. Nothing.
Yeah. So what it does is it should give potential investors looking to add to a portfolio, or a new investor, some confidence that if for some reason they have to realize that asset, that they're not necessarily going to be smacked with unnecessary tax on the sale of that asset. It's become when it was out to 10 years. I mean, seriously. So,
it was.
Yeah, oh, absolutely. It was a stealth tax. But I think it's a far more reasonable standpoint on it. Now, obviously, the thing that you've got to always bear in mind is you only pay tax on the profit, right? So, you'd have to purchase it, and it would have to increase in value before that ever becomes an issue. But these things all just start to add up. Tax deductibility, that's a big one for me. So one of the things, therefore, we are starting to see is it makes sense, and certainly I would think that Matthew Gilligan in one of your upcoming webinars would touch on this, is that for a period of time, we were seeing investors purchase investment property in their personal name.
Yep.
Right? Because there was not so much of an advantage for them to purchase through a company. And that if you've got a company, there's the ability maybe to transfer ownership to a company. Bearing in mind that triggers a Brightline test that's now not as rigid as it was. So selling the property from your personal name into the company increases the amount of tax deductible debt that you have, because the company has to buy at market value.
Yep.
All right. That's a biggie, because then you can look to sort of debt restructuring to some significant advantage, and that's definitely now worth exploring, and we're starting to see quite a bit of that. We're starting to see quite a bit of that.
I mean,
yeah,
based on government regulations and government changing things that impact property investors, I think there's a level of importance. And I think at the very, very top of that is the OCR. I think it's the official cash rate. It's like if the OCR came down 1% overnight, it would make so many properties in New Zealand become cash flow neutral, cash flow positive, viable, essentially. So I think that's number one. Next one is deductibility. And then just about all of these other littler things, not littler, but less imposing on their own, like the Bright Line test, like the triple CFA, they just all end up as a groundswell. And it's quite obvious that post-Labour government, who I'm not even shy about saying I wasn't a huge fan of, like, let's be fair, property investors were targeted. We were absolutely targeted. We were an easy target. And they smashed us with all sorts of horrible shit. And they're now turning that straight back around again and just throwing it back in their face. And this national government is doing a good job of warming it back up as quickly as they can. But I think they're a bit shit scared, and I think they want this property industry to come back strong and fast. And as we said offline, and while we were having a bit of banter before we started this, as property professionals, what we love is a slow burn. We like the same market that's just ticking over for a good 3 or 4 or 5 or 6 years, if possible. And I remember through, the property tutors days, it was just a beautiful, slow incline up, just ticks over lovely. You had that confidence that if you bought something, that it'd be a great idea within a year or two.
It's really interesting you raised that one, mate, because one of the things that Goodey also said in this presentation was that the post-market recovery from obviously what was a significant boom is very similar in look, and he put some pretty graphs up like economists do, to post-GFC.
Yeah.
There was a period of time after where we're almost identical. And so there was a slow burn after that. And a lot of the recovery was due to that availability of credit. Obviously, GFC blew it up, couldn't get it. I remember.
The liquidity came back. Same as it is now.
So so history always repeats itself, right? And the thing is, through that market, the reliability of the market allows trading to come back in.
Yeah, big time. I've been saying it for a year. It's nearly there. And honestly, right now, I think it's there. There's just so many listings out there that you can actually, pick and choose a little bit. You really can.
Yeah.
I was talking to my good friend Grant Hoey this afternoon, and he said, went to a Barfords auction and there was like 17 properties going up in Auckland this week. Central City Apartments, his thing, but only one sold, and the market's just become more realistic from that.
Yeah, one of my team was looking to purchase a house, through Barford auction. Not sure if it was the same auction, but I think there was 10 that came on, and only one sold under the hammer.
Yeah, it's a buyer's market.
Absolute buyer's market, for sure.
So what strategies are property investors currently using to navigate challenging lending environment? Well, I think the lending environment's getting less challenging, which is helpful. It's coming to us. What are investors doing that's actually helping them out?
Oh, look, I think it's for me, it's a collaboration piece, right? So I think, good mortgage brokers out there best when an investor comes to them with some idea of what they want to do. Okay?
Yeah.
Now, and then it's about looking to see if we can execute that, and also looking to see if we can have some flexibility around what the solution looks like. All right. Now, the numbers always deliver an outcome. It is absolutely a numbers-based game. All right. So, and investors need to be in a situation, if they want to challenge the current environment, and it is getting better, is have a plan A, B, and C, and have some flexibility. So what can be frustrating is a situation where the client goes, "Well, I've got to do this with a bank, otherwise I'm not doing it." Well, there are other options.
Yeah,
and it's about, and particularly if you've got some smarts about how to go about executing the deal. That's the key. So, we've got some good stuff floating around for some of your clients where we can't bank the settlement. right? Because when you're looking at a new purchase and you're looking to settle on it and you're looking to bank fund it, well, the only thing you can do is get a rental appraisal on it for the income, right?
Mm.
Now, if at that stage the servicing doesn't work, we're not settling with a bank, but we can settle with other options, because once the investor buys it and we can tool them up with the resources to add the value, and they're turning it into a room by room, or they're turning it into whatever income streams, and we know what that looks like, then we can predict what the exit looks like. So we can go, look, we can't bank it. We're going to settle with a non-bank. You do the add value. This is what the exit looks like to bank land. It's going to take 4, 5, 6 months.
Yeah.
So it's about looking at more complex lending strategies that support more complex asset acquisition.
Yeah.
That's where the workarounds start to sit. And just start being really creative with that.
Yeah. And what I'm seeing for the first time in 3 or 4 years is personal jealousy of the deals that some of my clients are finding. Like, honestly, you know it's good when the market turns and you look at a deal that a client's got under offer and you go, shit, I wish I'd found that one, or I wish I'd put that in my portfolio. And I don't know if you've been watching some of the seller purchase agreements come through and some of the returns and stuff, but we have a particular client who's actually out of the country at the moment, who's got one at 16% gross and one at 21% gross at the moment. And he's banking both of them, putting them in his portfolio. I don't know if you saw that one come through, but holy crap, that's a lot of income. You got to remember that a 25% return pays itself off in 4 years, like, wow. And so if he's grabbing that at this stage, doing the renovation, putting it into his portfolio, proving that return and refinancing it in a year, and if it takes 8 or 9 or 10 months for that to finish, and this market keeps bubbling and warming up by that stage, some of those properties could, go up a few $100,000 before he's finished doing the renovation on it. And that's where that trading piece comes back in, and you start getting that swagger and confidence that it's all a working thing. I'm loving that.
Yeah, huge.
So good. All right. How's the property market evolving at the moment, and what should investors expect the next 12, 24 months? So, this is the big, nasty, Dave's obviously got a crystal ball question. Where do you see it going? What's your feeling on it?
Well, I think obviously we will all agree that the property market's down, it's been flat, and there's lots of stock on. Right?
Yep.
Now, if you subscribe to what I said right at the very start, that the demand's there, it's just purely about availability and access to credit and the cost of that credit. If that starts to change in the right direction, and it has started to, then the demand will pick up the slack, and some of the stock levels will start moving, and there'll be little things like an increase to FOMO will come back. Investors may have better cash flow opportunities, but they'll come back. Look, I can only see my thought here would be, Steve, is that I think the market will go about on a journey of correcting itself, and I think we'll have some strong and steady activity over the next year or so. It's not going to go boom.
No, I don't think it will either. And I could totally see that. Yeah.
And it'll keep going in that direction until test rates get so low that DTIs kick in. There you go. That's my prediction.
Yeah. How's that going to work, you think? I mean, I looked at the DTIs and I looked at a few of my own portfolios and client portfolios, and I just don't see that there's very many people that are pushing the ledge that is debt to income ratios. I don't think that rule is going to hurt too many people. Do you know what I mean?
Yeah, not for a while. Not for a while. All right, because at the moment, a deal's more likely to not work because the servicing doesn't work, because the test rate's too high. And I think the thing with DTIs is designed to stop a boom.
Yeah.
All right. So when test rates get incredibly low, like they did through COVID times, the DTIs would have stopped or put a lid on that boom. All right. And to be frank, I'm all right with that. I think heading forwards, if you look at it and go, okay, we're going to have a slow and steady recovery, right? That gives people certainty, right?
Yeah.
It also avoids speculative activity. I'm okay with that too. And it rewards the smart investor. Negotiate well, buy under value, increase the value, and you create the gain in value rather than getting it fortuitously because the market's gone off.
Exactly the same way we did when LVRs came in.
Yeah.
We did to build in more equity to every deal.
Yeah.
The market just recovers and handles.
yeah, the smart buyer will go up.
Yeah, no, love that. Awesome. What are the best practices for leveraging equity from existing portfolios to fund new property investments? I suppose this is an age-old question, really. Exactly what everybody's after.
Yeah, it's the tried and true. The first thing you've got to do is measure up what equity you've got, and the one thing that doesn't vary when you start looking at an equity position is the level of debt. We just hop on the internet banking and we know what that looks like. That it's about looking at the different ways of measuring value and understanding what the true value is of the security. Because banks use different online valuation methods. They could be low. They don't use CV. Forget about that. And is it worth running off and getting a registered valuation done? So, measuring it up in the first place is the key, because whatever that number is going to represent a 30% deposit on your next purchase. Yeah. And that then dictates and influences your marketplace. Now, you can get 80% funding on an investment property, but to be fair, you don't want to stay there for too long because it's non-bank land. But at least this calculation got 5% better than it was.
Yeah.
So, and if you've got a number of properties in a portfolio, those 5% add up. So,
yeah. I mean, if you've got 2 or 3 properties, it's going to make a difference. If you've got 10, it's going to make quite some difference. I've got friends, obviously, who've got 100, 200 houses in one portfolio, and they're just allocating asset to each bank as they go along, having a field day. Yeah. How do investors prepare for potential drops in interest rates? So we're under the assumption here, obviously, that interest rates are on their way back down again. How do we ride it down safely? You know what I mean? With the best advantage for ourselves.
Well, I think you've got to understand what what your current rate situation is when fixed rates expire. Decide if you want to break now.
Yep.
And ride it down. A lot of different calculations to be done with that, and certainly we're always available to have a conversation about that thing, because you just got to make sure that you don't get smacked with break costs, or you're just waiting to that particular point in time. And it's all relative, because you've got a certain rate now, you break it, hop onto this rate. If you wait 3 more months, you could be hopping onto a lower rate. Hey, look, it is somewhat a guessing game, but
there's a lot of moving
what
parts.
You've got to do is think about it, right?
Yeah, and I think looking at your fixed rates that are 8 or 9 months to run or less, and figuring out what the break costs could be on those is really actually quite important, because if it's a small loan or if it's not a big transfer cost, it can be worth doing. And it's worth mentioning that there's a really good calculator on Sorted. That's it's .org.nz, I think, isn't it?
Yeah,
that will
help. A calculator on interest.co.nz as well. Yeah, and sometimes you look at it and you figure out there could be some break costs here. Well, what you do at the same time as breaking is you change bank, get a cash back, and you get a net gain.
Wipe one out against the other. The other trick I did back in the day was, if I was looking at breaking a mortgage like that, I always tried to do it very near the end of the financial year, because a break cost is a bank fee. It's not penalty interest rate, it's an actual bank fee, and so it's directly deductible on your tax, so you can get a refund out of it at the end of the financial year. So you wouldn't do it at the start of the financial year as easily as you might do it at the end. And I've paid $30,000 break fees in the past just to get out of one particular lending because the next one was more appealing. Yeah, no, I like that. Yeah, it's a really interesting mental scenario to kick that one round, and once again just takes me back to talk to your mortgage advisor. Yeah,
and take the responsibility to look at your own situation too. I think I interviewed a couple of clients a couple of days ago. They had one loan that had been on floating for 8 months because they hadn't got around to fixing it. It's like,
wow. God, probably an 8% or something.
Yeah, it was crazy. So yeah.
So what are lenders currently looking for when they're approving loans to investors in New Zealand? What whets their appetite, so to speak?
Oh, it's all about serviceability, mate. The servicing.
It's probably got to hit all anymore, is it? It's just the gone.
Yeah, so those, going back to the good old days, Steve, you'd have you could have an older client with 20% lending against massive portfolio, and servicing doesn't work, but the bank would lend because their security position was good.
Yeah,
not these days, mate.
Yeah,
so it's all about serviceability. So, and just that everything's got to be neat and tidy. Don't have unpaid things going through your bank account and overdrawn accounts and all that sort of stuff. Take that as read. We all know that.
Yeah.
But the number one factor that we look to is serviceability. You know, we quickly move through the equity piece. We can calculate that very quickly. Yes, we have the equity to do something, but do we have the serviceability? And because that's such a big influencer on outcomes and markets that someone operates. It could be the difference between buying in Auckland or Queenstown, or as opposed to maybe Hamilton and Tauranga. So this is where, again, investor flexibility around where their market is useful, because if they come on into us going, we want to buy another one in Auckland, they go, well, actually I can't, but you could buy one in Hamilton.
Yeah.
And you want to, no thanks, or all right, I'll take a look at that.
Yeah, I love that. What emerging opportunities in the New Zealand property market would investors be aware of right now? Like I suppose this is a question of, at this point in the cycle, where do you see the pot of gold is? Where's the value?
Right, mate, I think maybe it could be just as much your question as mine, because I think that there's got to be a massive amount of opportunity out there. There's, when you've got stock on the market, vendors are obviously wanting to sell. Give them the right price, they'll sell it. But it depends on how low can you go, and what sort of situation is the vendor in. We know as we get towards the end of an inflationary cycle like this, that the one thing that starts to creep in is job security. Okay, and we know that there's plenty of that sort of fear going on as well. So if there'll be distressed vendors out there, which will create opportunity. So I'm not sure if any part of New Zealand's particularly emerging. I think it could be quite simply across the board. But I just feel that if I was an investor tuning into this webinar and hearing what we're saying, and it is that I'd be starting to look into whatever market interests you and you feel you have expertise and understanding is, and start to reconnect with the agents in your market, because I'd be doing that today rather than next month or the month after.
Yeah, no,
because it takes time. It takes time to re-engage. I think that's the thing I'm saying. Is if you're a new investor or a re-emerging investor, it takes time to re-engage with your market. You've got to get your market data and knowledge back up to speed. That's got a 1 or 2 month lead in time, in my book.
Yeah, for my way of thinking, I look at my own property market here in Wellington, and the absolute peak of the boom, it was just so incredibly hard to get your hands on any property. There'd be 20 offers for every tender. There'd be rooms full of people at every auction, and it was just incredibly hard to buy anything, let alone buy anything at a good value. And now the values are down, and you can buy stuff, and you're not competing with people. And at that very, very peak, Wellington had between 800 and 900 properties on the market on TradeMe. And today it's 2,611 properties. So there's been a 50% increase in days to sell. There's been a 50% increase in properties available on the market. And as investors now, we just have a lot more choice. But also it gives us the ability to go looking for those motivated vendors. And the way to do that is a massive amount of activity, put lots of offers out there, make lots of offers on lots of properties, even if they're just purely fanciful and conditional offers. Put that level of activity into the marketplace and you'll start to see some crazy things. And this is a series of webinars, and you'll see that. I've got a couple of clients that are going to jump on and talk about doing massive amounts of sale and purchase agreements and what happens and what that does. So yeah, tune in for that one. I think it'll be very, very interesting.
Sounds good.
I just think that the market now is so good that we don't know how good it is at the moment. And it's going to get very interesting very quickly. And we're all going to wish that we had jumped in and started hammering our mortgage broker for more funding, 3 or 4 or 5 weeks ago. It's going to get, red hot. And then based on that, obviously I'm doing this 6-part webinar series because I've got my bootcamp coming up very shortly. And we're doing another Eden Park, Auckland property investors bootcamp where I get all of my great professional advisors like Dave along to give advice and to encourage people and rack them up and get things moving along. So what we've got tonight is a launch, I suppose, of the Succeeded Property Bootcamp. Once again, it's going to be totally updated for today's market because man, the number of things that have happened in the last 6 months that are different to the 6 months before that, everything has changed. And as you say, Dave, like in the lending market alone, a couple of major changes and just everything small has changed as well. So we're going to be absolutely updating that. And I understand you're going to update your content as well.
Definitely. We'll have some positive things to talk about, maybe. Good.
It's finally, right? It's absolutely starting to move ahead and roll along. And we're going to, show you where the absolute big wins are in this market and cover, hopefully, as much as we possibly can, given the fact that we only have one full day. And trust me, this webinar's only been going 30 odd minutes. We can cover some stuff in some short period of time and get you to understand some really key stuff. I'm also going to, this year, obviously, again, bring along my investor panel, because I think it's always acceptable to listen to like myself and people like me in the industry, but how cool is it to listen to other investors that have really pulled their socks up and got stuck in and done some stuff. And I think that's hugely important, to listen to other people that are actually exactly where you might be in your current positions at the time as well. Obviously, bringing in a whole pile of insightful people, not only Dave himself, and no doubt your son Jack will be dragged along kicking and screaming again. He loves it. But also Matt Gilligan, who's going to be doing a webinar with us very shortly as well. And Mark Trafford, who does a lot of renovations and talks about add value an awful lot. And I've got a special mystery guest who's just in the last few weeks sorting himself out to become the New Zealand's next full-time property investor as well, and kicking his job out and getting absolutely stuck in, who's a person who's been a client of mine for a couple of years now and is really tearing it up and making some huge gains. And he's going to explain what he's doing and how he's doing that as well. Obviously, these are, pretty big events, and we normally get 400 or 500 people in the room. And so what we try really hard to do is promote a lot of great networking. So there's been a few hundred people in this webinar tonight, and obviously the chat function's been going crazy on the side while Dave and I have been talking. And what we try to do is promote that within the event as much as we possibly can. So big round tables, you'll be sitting with 10 other people, whole pile of people you might not know, and you can then talk to them and network with them. Now, the way that we do that best is, if you buy a ticket to my event, I will buy you lunch, which means that we will have catered food on site for everybody, so that you don't have to leave the Eden Park grand room and go and find your own lunch and then come back and lose enthusiasm and lose the ability to sort of sit down over a sandwich or whatever and have a conversation with the people around your table as well. And I've most definitely created a situation where people around the tables have done joint ventures with each other, or shared horror stories, or done things that have been really, really helpful for each other live at the event while they're learning a lot of the skills and strategies that we've been putting in place with our clients over the last few years as well. So obviously, to thank you guys for showing up for the first of what is going to be a 6-part webinar series. I've got a webinar special offer for everybody that's online tonight if they'd like to purchase a ticket to my one-day boot camp. But also, Dave's thrown in a very decent bonus of his own as well. He's going to do a prioritized lending assessment for anybody that signs up tonight, which means that him or his team in their offices or regionally around the country will be able to have a look at your current lending and spotlight any issues, problems, great advantages, and hopefully give you some sort of an idea pre-event through their expert guidance with a tailored solution that's specifically just for you as an investor, what it is that you can do. Now, Dave's very, very good at this, figuring out where people's income is, where their equity is, how this all works, to give you an idea of what you could lend if you decided to go out there into the property marketplace and try and find some more cash flow producing assets. So thanks, Dave, for that. I really do appreciate that. We've got a limited number of people that we can offer that to tonight. The other thing we're going to do tonight is we've basically got 25 tickets this evening for sale for the property event. So for the first 25 people that grab a ticket, they'll go into a draw, and 2 of them are going to be upgraded to VIP. If you buy a VIP ticket, we're going to give if you're a winner of that and you've purchased a VIP ticket, we're going to refund you the difference. So somebody's going to have a nice little win out of that as well, just as an added incentive for everybody jumping online here tonight and getting stuck in. So all you need to do to grab yourself one of these tickets to our boot camp in September in Eden Park is go to stevegoodey.com/Auckland, and you enter the discount code webinar, and you'll get a 25% discount off the ticket sale price for the first 25 tickets sold. Then you come to the event, you learn and you network, and you get stuck into it, because I think 2022 was better than 23 was better than 22, and I think 24 will be better than 23. So I think now is absolutely the time to get absolutely stuck in and start the very beginning of the process. And that's why Dave and his team is the start of the process. Talk to your broker, figure out your lending, figure out your capacity, figure out what you can borrow, what you can do. And that's why we had Dave on first up. Now, we're going to give you a lot of free information over the next 5 webinars that we've got to go, but you won't get a better deal than this for tickets to our full one-day event as well. So make sure you do jump on there and go to stevegoodey.com/Auckland, enter the code webinar. You get 25% off the first 25 tickets sold. Obviously, of those 25 tickets, somebody's going to get upgraded to VIP. And also, those 25 people get a free lending assessment from Dave as well. So great idea to get in early and get your tickets as early as you possibly can. Now, as I said, I do have 5 more webinars to go. They're going to be on Wednesday nights. I've tried hard with the tech in the background, but I'm a property guy, not a tech guy. So what we've tried very hard to do is make sure that everybody who's registered tonight is also registered for the next round of webinars. So everybody will be getting some emails about those as well. And we're going to be talking about building your property business with Scott, who's just gone full-time or going full-time. We're going to be talking with Matt Gilligan, who is New Zealand's premier property accountant and a very, very full-on property investor himself. I'm going to be talking to Shane Carruthers, who's an expert in trading, because I think it's really time we started looking at and talking about the income available from trading property. And also going to be talking to Mark Trafford, who runs a massive renovations company, about staying safe with cost price of renovations and making that work properly. Now, the reason we renovate, obviously, is we buy a lot of shitters. We buy a lot of ugly houses. We buy a lot of horrible stuff nobody else wants. And the reason we do that is because we can add massive value to it very, very quickly, so that Dave can then recycle that equity and that new valuation to buy the next thing. And throughout my property investing and coaching career, I've always been very, very interested in making sure that the next thing you do helps the next thing you do, helps the next thing you do, and having that continuity, because we want people to be buying houses for the next 10 or 15 years and ending up with a portfolio of 20, 30, 40 houses, not buying something and getting stuck, which is what we're fervently against happening. So if you've got any questions, chuck them into the questions side now. Otherwise, go over to stevegoodey.com/Auckland, put in that webinar code, grab your tickets and bits and pieces, and we will rip into it. Anybody else has any other questions, type them into the questions side on the side of your screen now, and Dave and I will stick around for another 5 or 10 minutes to answer the questions if we possibly can.
Happy to wrap up with a few questions, Steve. I think
questions from the crowd, and then I'm sure everybody.
If the wife calls me and tells me that we've got the numbers, I might just have to disappear, mate.
Yeah, like that. I don't think you're on the wrong one there. Roger Rabbit there reckons that Lotto's being drawn soon, so he'll be totally fine. I'd like to ask a few questions of the person who logged in tonight as Chris Luxton from the Beehive. I think that's quite clever. Hopefully it's the real Chris Luxton and he takes a bit of a lead from us, Thanks to Diana, who says, really appreciate the webinar. Thanks for putting it on, Steve and Dave. No problem, guys. This is, I'm sure, what Dave and I would consider completely watered down and very basic stuff. And we are really looking forward to getting into more advanced strategies at the bootcamp one day as well. So make sure you do grab your ticket for that.
We've got Kelly's comment there about already got tickets to the boot camp and absolutely. Just Google's your friend. You'll find me there. Flick me an email, Kelly, and we'll do what we can do for you.
I mean, that's a key comment actually. Because we get so many people every year who come along to the boot camp. They come along to the boot camp, and you guys got to understand that you choose yourself. If you looked at you've gone to a free webinar and then you buy a ticket to the boot camp, and that's the precursor to you actually getting stuck in and really getting involved in property. So the next thing you need to do is get some funding. So we want to recommend as many people as possible who grab a ticket to our boot camp, go and have a conversation with Dave and his crew before the boot camp as well.
Yes,
Because we're going to get you pretty excited. Yep. Oh, Phil, mate, top of the South boot camp. Oh, I know it's tough, right? I know it's expensive to come up to Auckland, but honestly, you think it's expensive to get to Auckland, you should see what it costs to put this on. This is a very, very big event, and the Grand Room at the Eden Park is not cheap, plus a lunch for everybody. So unfortunately, for the at least foreseeable future, it's going to be Auckland boot camps only. So if you're waiting and holding out for me to come and do another one in Christchurch anytime soon, then I'm sorry, you might have to wait a little bit longer. I'm sorry about that.
The last Christchurch was great.
Well, Christchurch is fun, yeah, but it's just really expensive to get down there and run everything down there. I know. I love Christchurch. So, Dave, what's the average lending rate for second-tier stuff on residential and development in the market at the moment? Is there an average?
Oh, look, indicative. I'll use that word. I mean, if we're talking around a residential development, 3-4 properties on one title, townhouses, that sort of thing, you're looking at late 9s to sort of late 10s as an indicative rate range on that sort of funding. Appetite's reasonable at the moment. It's not huge, it's reasonable. And the key with that, if you're looking to get that sort of project off the ground, is having a low LVR starting point.
Yeah.
All right. So if you're already sitting at 60 odd % on it before you sort of remove an old house and then sort of come and ask for some development funding, pretty unlikely unless you've got pre-sales. But if you've got a really low point LVR, there's funding to be had around there.
Yeah,
don't forget also these guys will charge some fees, and brokers will charge fees as well because they don't pay commission. So there's a package deal around pricing there. But there is a bit of appetite, and one of the major development funders has recently sort of brought online a big, strong funding line. So there's a bit of competition out there in the market too. So
yeah, and 9 or 10% in my mind doesn't seem too bad as long as you've got an exit strategy. As long as it's something you're actually going to do something to, you're just not going to sit there for a year or two at that level,
Yeah, 100%. That's what Meredith Graham, long time no see. Meredith, very good property investor. So thank you for your feedback there, Meredith. Phil Muir too. Good to see you there, mate.
Yeah, lovely. Yeah, you get so many of the same names coming through. You really do, mate. Yeah, it's brilliant.
The key with that is there's a couple of names on the list there that are actually quite experienced property investors. So what I like about that is that they're still wanting to make sure that they're up to date with the latest of what's going on, and don't think they know it all. And that's a sign of a quality investor who'll keep going forwards.
Yeah. Not too sure about this question from Mark. If you want to purchase a rental with huge yield, would that be able to? Able to what?
Bump up your serviceability.
Serviceability. Yeah, there you go.
Yeah, look, theoretically, but the yield would have to be so massive because basically how it works, Mark, is that every time you take on board more lending to purchase a property, your serviceability decreases.
Yep.
All right, no matter what. Okay. Because the rental income is always haircutted, for want of a better word, to some degree. Now, some of that's changed a little bit and got a little bit better. But if you're thinking that on average it's going to take a 30% haircut, then it's very, very unusual, and I haven't seen it for a long time, that you could do a servicing calculator on an as-is position and buy a property and the servicing calculator is still the same.
Yep.
I haven't seen that for eons. So although yield's very important because obviously what it does is it keeps your serviceability up, but it will never, and that's why, a rental purchase will never self-service.
Yeah.
From a lending perspective, it might cash flow. Hopefully it does. Otherwise, don't buy it. But it will never self-service the calculators. They'll always go backwards.
Yeah, fair. There's a lot of lending options there, and I think this question from Zane, we've answered that in the previous comment about second-tier lenders and asset lenders.
Yeah, look, similar for development funding, for renos and flips, the main outfit we use have just pulled their rates down a little bit. Again, it's another indicator of as things become, because most providers in that second tier space doing short-term funding for renos and flips, that they'll be working off of the OCR rate. So if the floating rate starts to edge back, your cost of funding in a variety of areas is going to come down with it too, which is good. Again.
Yep. And yes, Philip, I will be. I do love to convert a property into a boarding house. Great for serviceability. Banks do hate them. Let's be realistic. But investors love them, and yes, I will definitely be having a few conversations about that at the boot camp as well. You couldn't leave that one alone. I love that. Yeah, interesting question there, Dave. What are a couple of things you can do to improve serviceability?
Normally, the quickest ride to hoe is increase personal income.
Yeah,
that's basically the bottom line, right? So more income is going to give you more serviceability. It's unlikely to be the little things like not drinking so much coffee, although we don't have to worry about that these days. I'm being a little facetious. So sure, you can improve yields. Doesn't matter what you do to improve your rates, because the serviceability rate's going to be used. I mean, Tusha, I know you pretty well, mate. I know your situation. I know you're going to buy another property, and potentially for you, it's actually the servicing rate changes that could influence the ability for you to purchase again, because of that rate being applied to all of your debt could make a reasonable difference in your situation.
Yeah, absolutely. I'll have a go at answering this one. Once the property's been renovated, what yield are you aiming for in general? I'm bound mostly when I'm looking at this by what interest rate I actually have to pay to own the asset to a degree, but I'm always pushing interest rate yields as high as humanly possible. And that comes down to, you're not going to get 12% return in Remuera or Oriental Bay in Wellington. And so it comes down to the quality of the asset type of thing to a degree as well. I've certainly got clients who are doing 30 and 40 bedroom boarding houses in Whangarei and Wanganui at the moment for between 16 and 22% yield, but it's not everybody's cup of tea either. And I think it's dangerous to try and look at a portfolio and have all one type of asset in your portfolio as well. I think you've got to look at portfolio health on more than just a yield basis alone. So I think there's a lot of moving parts to that answer. But honestly, I wouldn't really buy anything with less than a 7 or 8% gross return at the moment. And I would be aiming for that to be higher than that post-renovation, if yield and return and cash flow is what you're buying the property for. If it's just a pure equity grab, that might be a slightly different thing. Dave, any thoughts?
Yeah, mate. I think it's for me, it's all around making sure the property adds value to whatever goal direction you're heading in. So if it's equity you need to go buy it, if it's income you need to go buy that. And it's interesting, just going back to that rental income one, because one of the beauties of having Jack in the office and his ears are flapping is that he just ran some quick servicing calcs, and if you borrow $500K, you're going to have to produce around $1,150 of rent.
Yeah,
for that to have equilibrium on the servicing calc. So that gives you an indication. And the issue with that, of course, is that it's rare that you're going to buy that. It's something you have to create. So your servicing will go backwards before it can go forwards.
Yeah, I get asked this all the time. How do you find these high yielding properties? I'll say, well, you don't find them, you make them. It takes a little bit more thought process and creativity. And also, when you're doing that calculation, if you're doing that calculation, a real rough test for that is $500,000. Take the first 3 digits, 500, and double it. It's got to be at least more than that. So 500 times 2,000, yeah, it kind of works out. Getting asked, would you touch mortgagee sales? There's more and more of them popping up. I'm a little bit allergic to mortgagee sales. I don't particularly like them. It's a bank throwing a massive spotlight on a person and having their worst day ever. And I know that the market has to pick them up and somebody has to grab them. But for my mind, we often don't get access to them. We additionally don't get a chance to do as much due diligence and make ourselves as comfortable as we possibly hoped we would. And the type of marketing that comes up on them means that absolutely every man and his dog is after them. So I was run while I was in Europe at 3:00 in the morning in Switzerland, and because of the name on the phone of the agent that rang me up, who's helped me make us so much money in the past, I answered the call. bleary-eyed, and he had a group of 5 mortgagee sales ready to go. And I said, have you called this guy? And he goes, yep, he's keen. I said, cool. Well, if he's keen, I'm out. Because competition's the death of a good deal. I don't want to compete with people. And mortgagee sales just highlight that it's going to sell. So
biggest issue is insurance, right?
Yeah.
The biggest is insurance. Generally speaking, the insurance disappears on the fall of the hammer, right? There's always terms and conditions in the agreement which says that the bank, let's say, won't carry the insurance through to settlement, and it's basically impossible.
They can beat the place up, and they can not leave, and it's just it's an old-fashioned property term, I know, but it's a ball ache. And there's so much stock on the market at the moment. Why wouldn't you just go to Trade Me, find the region you're after, and find like 3-bedroom standalone property, and go latest listings, and then go to page 30, go to the old stale stock, and start from the bottom of Trade Me, and come back up and call some real estate agents, and you'll find deals that are at least as good as a mortgagee sale. Plus, banks and lenders tend to look at them more closely if it's a mortgagee sale. They want to know if there's deferred maintenance. They want to know if there's a structural issue with the property. Is it watertight? All the rest of it.
Yeah, I think in general, when we've got it working with a client who could be seriously looking at a mortgagee property, we're actually not using it as a security. Our best workaround is we've got so much equity elsewhere.
Yeah, use something else.
Yeah, got to.
Cool.
Otherwise, minefield.
All right, well, I don't want to hold you up all day, Dave, and we're about four tickets away from getting their 25 tickets sold. Been sitting here watching them tick over. But thank you so much for your time tonight. Everybody's been really complimentary about your information, and really looking forward to seeing you at the event, and putting a lot of the people that buy tickets tonight across to you, and getting you to help them out with the start of their lending journeys, or the continuation of. But thanks for your time tonight.
Thank you, everyone. Appreciate it.
Thank you. Thanks for that. All right, well, thank you, everybody, for jumping online. I'm going to leave the screen up for those of you that are still just jumping through there and grabbing the last of those 25 tickets. Obviously, we're going to grab 2 of those and make them VIP for free, and anybody that grabs that ticket tonight gets that free lending assessment. We won't be able to do that for following ones because we can't inundate Dave too badly. But if you've jumped on tonight and you've really enjoyed this webinar, look out for the next 5 in the series. We really look forward to seeing you. Hope this has been of great interest to you. And obviously, there's a comment section. Chuck in a comment if there's any other information that you'd like. We're obviously gearing up for this big one-day event. We want to make sure it's a full room of really enthusiastic property investors. So make sure you do grab your ticket and jump in on that at the moment. All right, I'll leave the screen up for a little bit, jump out of here, and look forward to seeing you at the next webinar. Thanks very much, everybody. Bye.